AVV Nation and all of YouTube out there, what's going on? My name is Patrick France, Senior Instructor here at VectorVest, and over the last few days, we've seen a lot of talk about the yield curve inversion. We're going to be taking a look at what one of the major Wall Street strategists thinks this could actually indicate, and also take a look at what VectorVest thinks about it and how to take advantage of these current situations to make money in the markets, regardless of what's going on. So if you're ready to learn more about the yield curve inversion, see what it's really telling us, and also see how to make some money during that current time, make sure to smash that like button, subscribe if you're not already subscribed, and let's jump right into it here today. All right, welcome back everybody. So to start today off, I want to take a look at the official Fed data and talk about what the yield curve inversion is. So typically when you hear people talking about the yield curve inversion, they're talking about the 10-year treasury and also the 2-year treasury. So what this is that you're seeing right above me is the difference between the 10-year and the 2-year. So if it is a positive number, that means the 10-year yield is higher still than the 2-year. And if it's a negative number below the level of 0, that means the 2-year yield is actually higher than the 10-year. And historically, this has been an indicator that the market is heading for, or the economy is heading for, a recession. But there is one caveat to always point out with this. Whenever they say that the market is going to be correcting or having a recession, you always have to remember that is typically followed anywhere between 12 to 24 months after that initial inversion. So as we can see here, looking at 2006, 2007, as we all know, it wasn't until about 2008 that the markets and the economy really started hitting that recession. And we can see the yields, or the inverted yields on these 10 and 2 years, stayed in negative territory for quite some time. Well, they stayed there for quite some time and then started picking back up leading into the recession. So while yes, this could be an early warning sign, it doesn't mean that the market or the economy is heading for a recession right now. And then looking at the most recent data here, we had an actually inverted yield curve back in 2019. That stayed there for a very short period of time and then bounced back up, and now starting to come back down and actually inverted as of yesterday, or Monday, April 4th. So looking back at 2006, 2007, leading up to that 2008 recession, we can see it dipped below for a brief moment, shot back up, then came back down for a second time. So it's going to be interesting, and something that we should keep an eye on going forward is if this one touch here is actually essentially this part here, and this longer term where we saw negative inverted yields comes in this portion that we're noticing right now. So this is definitely going to be something we're going to be focused on and see if it just snaps right back or if we stay in negative territory for a while. Because if we stay in negative territory for a while, that would be a stronger sign than just seeing a blip on the radar, essentially. So hopefully that gets everybody up to date, familiar with it if you're not already familiar with it. And now one article I found of interest that I wanted to bring to light here is one by a major strategist, Barry Knapp. Long-term Wall Street veteran. And one of the things he talks about here is that we're seeing the yield curve inverted more because of inflation, actually seeing inflation lower longer term, rather than the economic growth worries that everybody's worried about. So we come down here, get into the article a little bit. And as we talked about before, the inversions of the 2s and 10s for the 2-year and 10-year nominal treasury curve is not implying slower growth, but rather lower inflation in 2023 and beyond. So if you're somebody that's going out and buying stuff or buying basic necessities for your family, going out and doing your shopping, I'm sure hearing that is probably going to be a nice relief to hear. As we scroll down though, he gets into the maturities, talking about how they increased just a little bit and how there's a very minimal difference between the two. And then one of the things as we scroll further down, getting into it, is the final statement here. The equity bounce, he said, would be consistent with our analysis of the hawkish Fed pivot and also incremental increase in credibility. So he thinks that, this inversion that we've seen most recently isn't necessarily due to potential recession fears or growth fears. It's more due to inflationary fears and actually seeing inflation slowing down as we go forward in 2023 and beyond. So now with that, let's go ahead, jump right into the VectorVest 7 software and see what our market climate is talking about and what it's showing us. So I'll go ahead, simply pull up that graph real quick. And there we go. So what we're looking at is something that VectorVest covers every single week. It's our market climate graph where we use a few indicators and a few readings on the overall macro scale to get an idea of whether we're in a bear or bull market. And if we are in a bear or bull market, what point of that bear or bull market we're in. So we've been talking about a lot with interest rates going up, inflation going up, also earnings going up. That puts us in a case for bull market scenario, which is the end of a bull market. So while we are towards the end of a bull market, the end of a bull market can last for years. So just because we're in the later stages of a bull market doesn't mean we should all be going running for the hills, because right now still there's no better options out there to make a return on your money than trading in the stock market. So one of the things I just wanted to point out here is the ETI, or the earnings trend indicator. This makes it really easy for any retail investor out there. And what we're looking at is it's cast on a scale of 0 to 2, and above 1, as it's moving higher, means earnings are continuing to grow. And if it dips below that level of 1, that would be a warning sign, because that means earnings are actually decreasing. And as we say here at VectorVest, earnings are going to be the engine that drives stock prices higher over time. So with the 50-day moving average earnings per share of the S&P 500 continuing to ramp up, and with the ETI indicator continuing to ramp up as well, that tells us earnings are growing and offsetting the risk that we have with inflation and interest rates for the time being. Now, this could obviously change, and if you want to make sure you stay up to date with that, make sure to click on the link down in the description below, sign up for the trial, because every single week, every Friday, we cover this information to make sure that you never get caught off guard. Now, with that in mind, let's go ahead now that we know where we're currently at in the market, and take a look at some good potential ideas for trading ideas to take advantage of these later stages in a bull market. So what I'll do is I'll pull up the VectorVest 7 software. There we go. And one of my favorite searches, I've been here at VectorVest for well over 10 years now, and one of my favorite searches I keep coming back to is Premier Growth Stocks. I've found a lot of great opportunities with this over the years and made a lot of good money utilizing this search. Now, cherry picking can be obviously a benefit to you, but you can also just take it as is and take advantage of it that way. One of the main powers of this search is the sort that it uses, where it's looking for the highest combination of VST, which stands for value, safety, and timing, one of our proprietary indicators here, RT, which is a momentum indicator, and also CI, which is a technical indicator, which shows the stock's ability to withstand a severe lengthy price decline. In essence, stocks that have a nice smooth upward trend have a higher CI. And so it's looking for the highest combination of all three of those. But the stocks also have to have a higher market cap, a growth rate, a forecasted earnings growth rate per year of greater than or equal to 14%, and a few other factors here. So looking at some of these ideas, we have NUE, Nucor, which has been a top VST stock for quite some time, Mosaic, CF, Avis, which has made a lot of headlines as of late, Alcoa, CNQ, or Canadian Natural Resources, and a few other popular names that you've probably been familiar with for quite some time. Now, at the time of recording this, the markets are looking pretty ugly because we did have a Fed member coming out earlier in the morning talking a little bit more hawkish than they typically speak. But even with that, most of these stocks are still holding their ground or pulling back a little bit, but still maintaining their strong price action. So let's go ahead and take a look at the graph of these real quick. So we'll simply click on the graph all button at the top, maximize it here. And what we're seeing is the price shown in candlesticks. We have a 3 and 8 exponential moving average to show short-term momentum. And then below that, the MACD here at the bottom. And then I have volume with the 50-day moving average of volume as well. So I'm going to take off the 50-day moving average of volume, take off the volume because we know these are pretty strong companies to begin with, and zoom into a 3-month time frame. So starting off with NUE, we can see on a short-term basis, we are seeing a little bit of weakness here over the last couple of days, but the 3 and the 8 are still positive. We've had a slight pullback in NUE. Now, could be one to keep on your radar. Wait to see it break to a new high and create that good buying opportunity. From a long-term buying opportunity, we saw an entry back here on the 9th of February. And since that point, it's gone up significantly here from roughly 120 to about 150. So about 25% already since that long-term MACD line turned positive. If we go take a look at the next one, MOS, another great looking candidate. We see on a short-term basis, it is pulling back, creating a good buying opportunity. But as always, VectorVest tells you every single day whether it's a good day to buy or whether it's not a good day to buy. So we just simply wait for that good opportunity or that good day to buy, and maybe we could take advantage of one of these. We move on to the next. CF, similar situation. Pulling back a little bit over the last few days. Short term pulling back, but longer term still positive on the MACD. So therefore, still a good opportunity waiting for that right time to jump on board. And last but not least, CAR or Avis budget. So as we can see, had a pretty big rally here ever since the beginning of March. Pulled back, the 3 and the 8 consolidated, and now the 3 is starting to break away from the 8. And MACD is starting to turn positive on a short-term basis, so could potentially be a great opportunity when we see that MACD line cross above the signal line. So if you want to see more of these stocks, make sure once again, click on the link down description below, sign up for the trial and put it to the test. You can go through the graph of all of these stocks on your own. And also let me know which stocks, if any of these that you've seen so far, you're interested in, and maybe you already own a few of these. Let me know down in the comments below. So until next time, it's been my pleasure being with you. Take care, adios, and toodles.